Okay, good evening guys. Before we start, as always, let's do a customer instant poll. Going to put this on your screens now. Let me hear if you can hear the volume correctly. Just going to set that up now. I'll keep talking, so please let me know if you can hear the sound perfectly, too loud or too low. Indicate by pressing 1, 2 or 3 to correspond. Okay, the majority of people are saying perfect. That's great. Thank you guys. Okay, so tonight we're going to talk about trading the news. So it's very, very important right now that we understand the fundamental news that's driving the market. Okay, we have a lot of rumours. The markets have changed substantially in the last 5 years. We have all these Twitter feeds that people look at. We have all these different news commentators use different mediums to get news out. But the basics of fundamental news doesn't really change. We're going to have our economic releases that's always scheduled and set. We're going to have our key economic speakers, people that will change policy and again change the tone of the markets. And also we're going to have other random events that happen. So we should always be aware of what fundamental news is, again how the market interprets it and what it can do to our products. So that's what we're going to go through tonight. So let's get started. Now, before I start, as always, I need to read the risk warning. Now, spread betting and CFD trading both carry a high level of risk to your capital, with the possibility of losing more than your initial investment. These products may not be suitable for all investors and only intended for people of the age of 18. Please ensure you're fully aware of the risks involved, and if necessary, seek independent financial advice. Again, this is education only. The content of the webinar is the personal opinion of the moderator, not Intertrade.com. The content does not constitute financial, investment, or tax advice. You're advised to discuss your specific requirements with an independent financial advisor prior to entering any bet. Intertrade.com is not responsible and disclaims all liability for the content of commission in this session. Okay, so we'll talk about fundamental data and fundamental news that comes into the markets. Really, we're referring to initially about economic releases. Okay, so when we look at our economic calendar, we can use Intertrader. For this, we have our own economic calendar, and it's basically a list of scheduled macroeconomic indicators, government reports and updates, as well as speeches by influential participants within the market. And also, again, when you talk about people that move the markets, it's all driven around the key policy makers. So when we talk about the ECB, again, it always used to be Jean-Claude Trichet, he was the head of the European Central Bank. Now it's on Mario Draghi. Any comments that come out from him can indicate the tone of what's coming out of the euro, and again, what policies might be changed. Other people we need to look out for, Angela Merkel. Again, Germany seems to be propping up the eurozone, so as leader, chancellor of Germany, we need to understand her tone and how she sees the debt crisis and the strength of the euro, etc., etc. In the US, we have Ben Bernanke, the head of the Fed, obviously the president, Obama, if he stays in or not. And again, anybody who you think, when they come out with comments over the news wires and release statements, anyone you think other investors will take notice of, again, you should understand what that will do to the markets and how you can profit from it. When we talk about economic releases, we generally talk about leading and lagging indicators. Now, again, if you watch any of my live trades, which I do 2 a month, generally non-farm payroll is the key one we do, we talk about different types of economic releases. So leading indicators, now these offer a preliminary sign of potential up-and-coming changes in the business cycle. Okay, so this is consumer expectations, building permits, money supply, things that really kind of lead the economy, hence its name, and really kind of filter through quite quickly. And again, these are the things you need to look at to gauge out what's happening right now, what's happening very, very soon within the markets. Now, lagging indicators, again, by their very name, indicate a change the economy as a whole, and again, allow us to assess actual magnitudes in movements. But again, these are more longer-term things that we look at. So these are unemployment-related figures and our consumer and producer price indexes. So again, you may have heard in the news in the UK that inflation has come down to around 2.5%. We gauge that by looking at consumer and producer price indexes, what it costs the consumer to buy things, what it costs the producer to make things, in relative terms, month on month, year on year. Now, unfortunately, we think inflation is going to rise, and these are things that are a little bit wider. Okay, inflation, it's really, really funny. Again, I can only go back to different examples of over the years how I've traded. 5-6 years ago when I was looking for market comments from Trichet, it's all about price stability. It was all about, we had the growth, we had the employment, and we're just looking to, again, control inflation to make sure everyone could keep hold of the money they were earning. These days, it's more about growth. It's about GDP, sentiments, non-farm payrolls, job creation. So we're not too fussed about inflation. We know it's not good for the economy, and we know we don't want it to be too high. But that, again, is where we have to understand when we're trading economic figures, when we're trading fundamental data, to understand the market sentiment as a whole and understand how, in what current business cycle, what data is important. So again, right now, we don't need to concentrate so much on the consumer and producer price index because inflation is just a byproduct of the economic situation. Again, we're much more concerned what's happening in the US, the emerging markets. Are the GDPs growing? Are we getting more production? Are people buying houses? Do people feel secure in the jobs? These are things we need to look at. Okay, these are things that the market is anticipating, pricing around, and trading off. So again, it's all very important that we do look at our economic calendars. We pick out the figures. They're not just important, but important for the current market conditions that we're experiencing. So what else counts? Well, obviously, non-farm payrolls is the biggest figure that comes out every month. Released on the first Friday of every month, and I always trade it. So again, you can watch me put my techniques, my teaching into practice. I'm very different than most educators. I'm a real trader. I've worked in finance for a long time. I've been a trader for a long time. The market has been my life. So I will put these practices into place and I'll trade the markets live with real money. So we don't always trade. We don't always get the trade off. But when I do see a good opportunity, we'll trade. And I'll put, again, all the different practices into place that we teach, like risk management, technical studies, etc., etc. But again, fundamentals is all about understanding what these figures come out and how we trade the markets accordingly. So other things we should look out for are interest rates announcements. Again, interest rates are historically low, but they're going to have to rise at some point. GDP, as I mentioned, the consumer price index and producer price index, again, are still quite important, even though we know that in inflationary terms, that's a byproduct, and we can't really do anything about that until we stabilise and increase growth. So that's just a screenshot of our economic calendar. Again, it's very, very simple. It'll tell you what's going to happen on a daily, weekly, monthly basis. Anything that's got a star against it is important. If it's really important, I'm trading it. If it's not that important, I won't be trading it. Okay, so you have to build up your own lists. Build up, what you've traded before, what works for your products, and make sure you have, again, a diary note or in your trading plan, an idea of when the figures you like to trade that affect your product come out. Again, it's another way of organising your trading day, your trading month, to trade around figures that come out. And again, try and maximise and try and profit from them. Again, I know a lot of people that just trade around figures, and you can make a living just off trading figures if you're disciplined enough and you understand what's happening. So again, it's something else to think about. If you don't want to trade figures, that's fine, but make sure you don't run a position over a big figure, because you don't know if you're intraday trading how much the market's going to move. So again, that comes back to your risk management. Understand, be prepared for what the market could release to you. So the general principles, pretty much everything I teach has two core underlying themes. The first one is you have to be prepared. You have to be prepared for the markets, be well organised and understand what you're doing. The second is that the trend is your friend. Okay? As a rule of thumb, it's preferred to trade in line with the underlying trend. Yeah. Other exceptions, again, can be when we break down below huge technical channels, we see big reversal patterns in the candles, or again, we just have an overall breakout in the overall sentiment of the market. But again, if you're going to trade with a figure, let's take non-farm payrolls, for example. If everyone's expecting it to be a good figure, positive for the economy, i.e. jobs have been created, then we should look to buy into that strength. But again, the flip side of the coin is, if again, the market expects this figure to be a lot better than expected in the previous trading leading up to the release of the figure, we can see the market get bid up, and then the market comes down as people take profit. So that's when you get caught out. So again, these are the things we have to be very, very careful of when we're trading figures. So again, if the market's expecting a good figure, and the market moves up quickly, then you can see people sell out at that point and take the market down before it recovers and go with the overall trend. So again, it's all about timing. It's all about understanding what the market expects and not necessarily just jumping in as the data is released, trying to get a quick profit. Again, a lot of the times I've traded, I've waited for the figure to be released, and I've traded after the first 3 or 5 minute candle print to see if there's any kind of retracement, and then get in on the retracement or look for a continuation pattern. So it's all about being prepared. It's all about understanding what the market expects and trading accordingly. So if we're trading with the trend, This is a classic example. Just for argument's sake, let's say this is a 1 minute chart. So again, if we see some economic data released and we see that there are head and shoulder patterns, anywhere in the blue line, yeah, is where we're going to see the market react. So this is an upward trend, yeah, and we've seen economic data released. Let's call each one of these blue bubbles a piece of economic data. Okay, so the market's trading down here. It's broken through this parallel trend channel on the upside. So the market releases the data just at the low here. So what's going to happen? It's good for the market. It's positive data. Well, the market looks to test the low side of this channel, which again, that's support, therefore resistance, has a little bounce off, and then charges through and then trades back in the channel. Again, if we see positive news in the second blue bubble, then again we're trading lower. Positive news into the market. We start to trade along the level of support come resistance. And once we break through, again we break back into the overall trend and the market goes up. And again, likewise in the third bubble, we're hovering around the level of support, or maybe call it resistance if we're trading below, but support resistance. We break through, then the market tests along it, and tests the parallel opposite trend channel band. So this is the thing we need to look for. When good information comes into the market, it can take a little bit of time for it to filter through, and then the market, again, takes up and factors in this good news and then sends the market higher. Likewise, that would work exactly the same for bad economic data over in a downtrend. So it's all about managing it. It's all, again, being very, very methodical, being, again, emotionless, and just waiting for the data to come through and then going with the overall trend. Again, if that data's bad and the market's going up, again, you might have to change your opinion. You always have to trade with the market sentiment, the market forces, because the market's just too powerful to go against. Okay, so if the market isn't going with the trend and you don't understand it, maybe you have to sit back. That's, again, being a responsible trader, and again, the art form with what it is. Trading is an art form of being able to take a step back. And when you don't understand the market conditions, the market isn't trading in a way you understand, just to take a step back and save your capital, save your ammunition, until the markets then start to work in a way that you can understand. So there's always high risk-reward ratios apportioned with trading the news. Again, it's just because it's so volatile. And again, when you have so many people's opinions all meeting very, very quickly, we can get spikes in the market. So again, it's always key that you understand what size to trade in relativity to your capital that you have on deposit, and also understanding that the markets can move very, very quickly in a short space of time for and against you. But then again, as quick as they move, they can come back. So if you do get a quick profit, it's always an idea to bank some, to scale out of some of your position, because markets can retrace right back to your entry point and then further against you within that save move, because that's just how markets react quickly to data. Because there's people that are right, there are people that are wrong, people getting into positions, people getting out of wrong positions. So you have to make sure that you understand, again, that the actual volatility after the data is released is going to be vast. So again, it's just a different style of trading, and you have to think on the very, very short term. So again, it's all about, if you're generally trade off the 15-minute or hourly candles, you have to understand that if you're trading 2 minutes after a figure's been released, you have to put that into perspective and see how you normally trade. A market could move 3 or 4 times in the first 5 minutes after the data is released that it would normally in the first 2 or 3 hours of normal trading. So you have to put your stops in accordingly, manage your risk accordingly, and understand that with volatility comes the opportunity to make very good profits, but also the danger of losing much more than your initial risk reward on normal trading. So again, I'm not quite sure that chart's there, we'll just skip that. So a tight range. Now we always see a tight range before a big announcement. That's again, these figures are generally very, very hard to anticipate and very hard to predict. That's why these agencies, government agencies and independent agencies, come together to form this data. So there's a lot of rumours, there's a lot of speculation that people get these figures early. To be honest, I've traded in the markets for years and years and years. I've never had a nod on the data, and I know a lot of people. So let's say, for argument's sake, that the general market principles are that everybody gets the data at the same time. So you have to be patient. So again, if you're waiting for the non-farm payroll figure to be released, again on a Friday afternoon, then don't trade before it. Save your money. Save any angst. Save any again, negative feelings for the figure being released. Again, it's all about being prepared. Your opportunities to trade, the first 5 minutes, 10 minutes, 15 minutes, 2 hours after the non-farm payroll has been released. So why would you trade in the morning when there's a tight range and very little opportunities? Little tip, again, you're the trader, you have to make these decisions, but in my opinion, it's always worth waiting for big data and not trading beforehand. So identifying the trend. So again, observe the prices by using your candlestick charts. We should all use candlestick charts and understand the basic principles of charting. If we don't, I do plenty of technical charting seminars. So again, just looking on Novia for my next technical charting session, and again, pick up some tips how to chart properly. So we'll look at things like rising bottoms for a bull market and falling tops for a bear market. Again, compare things with a moving average. So again, we can use your moving average of 87 days applied on a daily chart. Again, it's all down to you what kind of moving averages you use. I generally use a 20-day and a 200-day moving average to get a good idea of where value is. So a 20-day moving average works because there's generally 20 days that you can trade in a month. Therefore, there's generally 200 days you can trade in a year. That's how I work it. That's what most of the traders I know use. And again, it's down to you. You can set your moving average over any period you want. But the whole thing about trading fundamentals and technicals is going with the overall self-fulfilling prophecy. If you're looking at the same moving average as everyone else, then that's going to hold. It's going to have relevance. If you use an obscure moving average, maybe you're the only one looking at it. Then how powerful is that in the markets? Yeah? Then again, the third indicator you can use are things like MACD, for market strength. Maybe you're going to use RSI, Relative Strength Index. Again, you can overlay any array of indicators on your charts, but it's down to you and personal preference what works. Don't have too much on your charts, again, is my personal tip, and only use things that you look at every time you look at a chart. If you look at your chart and you don't look at an indicator, it's of no use to you. It's taken up, it's dead space, and it shouldn't be on your charts. So again, this is telling us a simple chart that we're seeing a bull move going from the low side on the left-hand side to the high side on the right-hand side. The red line is the moving average, so every time we close above that, that's still a bullish signal. We can see, again, our MACD is the coloured chart at the bottom. So again, it's just moving, along with the chart. Every time we see the MACD rising, we're seeing that we're having strength come into the market. Okay, but remember the overall trend. Okay, the overall trend is still up, so that's what makes the difference. We're looking for low points in the chart, so here, 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 and here to buy the market up. Okay, so that's what we're looking for. Right, a market that's bullish, we're looking to buy low, sell high. Okay, you don't want to buy low, sell high, and then buy that low. You want to stick to the overall trend. Again, it's all going with the probabilities. You might be able to do that, buy low, sell high, sell into the move and make some money. But again, it's playing the probabilities. If the market's saying that we're trading above the moving average, the market is strong on the low points, yeah. And again, we're looking at individual candlestick formations, and we understand the fundamentals coming into the market. Every time we see weakness and a low point on the chart, we buy into that weakness. Therefore, again, the market gets bid up and we make profit. Don't try and be too greedy in trading. Don't try and be in and out too much. It's all about patience. Really, again, when you're trading on an intraday basis, you shouldn't be trading more than 5 or 6 times a day normally, and then around your fundamental information. So again, keep it tight. Again, the more times you trade, the more you open yourself up to the odds being out of your favor and having losing trades. So there's different techniques we can use when trading the markets. Okay, so again, if you ever listen to my live trading sessions, I always reiterate these. Now again, it's up to you as the trader. I've seen people make lots of money, and I've made money myself by trading all these techniques. Okay, you can take a position prior to the market release, so that's almost having your own idea of what the market data is going to be, and then taking a position before it's released. So again, quite high risk. The setting opposite orders in and outside the current range. So again, that's just filling your order book up. There's going to be a relatively tight range before the figure's released. So you put orders, open limit orders, on the top end of the range, the low end of the range, and strategic levels, hoping to get filled as the market quickly releases the data and goes up or down. So you're going to get filled at the streams of the market before it snaps back to some sort of fair value. And then you can trade the aftermath of the event, which is just the way I always trade. wait for the figure, see how the market reacts, and then make a decision accordingly. So, can you profit? Well, there we go. Very clever title. I can't take credit for that. Somebody else wrote that particular title. But that just basically means that we wait for these economic releases, wait for this economic data. And again, these are by government agencies, institutes, universities, some clever people. So what we have to understand is, can we look at previous data, previous releases, and see a pattern, then make a decision based on that? Now, you're trading with your own capital. You're not trading with clients' money. Again, so you're entitled to your own opinion. So if you think a non-farm payroll has been weak, and you expect it to be strong, then that's entirely up to you. You can go against the trend, you can go with the trend, you can make your own opinion. But basically, it's taking a long or short position on the product you trade, waiting for the data to be released, and then again, you're either right, and you have to understand where you're going to take out your profit, or you're wrong, and you have to understand where your pain threshold is, and where you have to exit that wrong position. Now again, as I've said, the markets will generally move very quick in one direction, and then move back to value. So again, it's not always it's not always the riskiest thing in the world to take a position before the figure, because again, 80% of the time, a market will retrace the initial move around about the 50% level. So again, you can factor that in to your trading. You have to understand the overall risk that you're taking on. You have to understand how long you'd have to hold your trade for in that scenario, and again, what that means to you. If you can take a large swing in your P&L and look to profit from that, that's fine. If you can't, then you have to exit losing trades to a very tight ratio. So again, it's all about understanding your risk reward and how confident you are in your own ability to predict these figures. But again, you're the trader. I won't say to you that you can or can't trade this way. Your money, your decisions. But again, with high rewards come high risks. That's all I'll say about that method of trading. So again, this is the Dow Jones prior to the 22nd of June release of the housing data. So again, we're seeing a very tight range, again, between this level of resistance on the top, level of support on the bottom. So that's quite nice. We know that we can trade along that. The market is not really peaking or moving in any one direction. So again, if you were to take a position prior to the data being released, you're not going to take much of a hit on the upside or the downside if the market ranges, that close together. But when we kind of zoom in after the data's been released, what we see is, again, where the blue line is, after that particular tight range, the market releases the data, we see a little bit of consolidation, some peaks and troughs, and the market really takes this data badly, and the market sells off quite a lot. So again, that's the whole point I'm trying to make. Sometimes this data takes time to filter through. So okay, you sell the bad data here within a tight range, or you're already short, so the market comes down to here and you can take some profit. But then the market looks to spike up a little bit, so you're really, really close to your entry point. So you might not get out, or you might scale out, but you have to wait, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, nearly 18 prints before the market then has this really big sell-off and starts to, this new range of support down at the bottom. So that just means that, again, you can wait for this data to come into the market, you can take a step back and wait for the overall range to be broken and the significant levels of resistance and support to be tested, before the overall move happens. So you can trade the markets in so many different ways. Again, you can scalp, you can trade, you can go with momentum, but it's all about understanding how your market moves and then setting your rules accordingly. So again, if these are minute charts or 2-minute charts, you're only going to have to wait, again, 20, 40 minutes before the market goes, okay, well, that data is significantly bad. That's going to send the Dow Jones down because it's negative data. Okay, but again, if that's an hourly chart, maybe you have to wait 2 days. And maybe that will not be due to the actual housing data. Maybe that's due to something else. You just don't know how long data is going to take to filter through into the markets. So you have to understand the market you trade, understand how quickly the market's going to absorb this information, and then how valid it's going to be. Okay, so it's more likely this is a minute chart. Overall, the market reacts to this data badly and says, okay, well, this isn't good for the economy. So again, the housing data, the housing stats are bad. It's bad for the overall economy, so the market sells off. So again, it's all about building up your experience, understanding how you've traded in the past, how your market's reacted in the past to these data releases, and making sure that you use the right trading technique to adopt. So then we have holding the stick at both ends. Now again, this is placing open to limit orders outside of the range. So the best way to describe this is, okay, we know that the market's going to be in a tight range before the figure's released. So think of it as an elastic band. Okay, the figure's either going to come out good or bad. Yeah, and depending on how good or bad it is, the market's going to react violently in one direction. So the market's seen some very, very good data. Okay, they will think of an elastic band. The market will stretch up to a level of resistance, yeah, and try and hit it, and that's where your order should be, on good levels of resistance, good technical monthly levels, weekly levels, good trend levels. So you're looking to get filled anywhere around that key level. Then like the elastic band it's found that value, so it lets go, and the elastic band snaps back to fair value, yeah, to that tight range we're trading in, and that's where you take your profit. So it's trying to pick the extremes of the market of where it could move to just after the figure has released. So you can do it on the upside, do it on the downside. Again, you can be prepared for any outcome. But again, you can't set them too close to the range, yeah, because if you've got multiple orders, you might get filled on too many market orders, and you might take in a position you can't warrant for your risk reward, or take on that's too big for your liking. And also, they're too close to the range. Again, the market might quickly fill them. You won't have time to get out, and the market continues in one direction. So again, if you have taken a view that the market's going to spike up 20 ticks and you get filled in that order, but you can't get out for any profit, then the market takes this data very, very well, and it can spike up 20, 30, 40, 50 ticks. So if you've got filled at 50 ticks, your entire risk is going to be that other 30, 40, 50 ticks the markets could move up to before it starts to retrace. So that's how quickly you can lose money on that technique. But again, if you pick wide enough extremes of the markets, you'll have a good chance of making money. So again, try and assess what the average daily range is, look at previous days' high and lows, and that's where you should start putting your orders in. So again, a very good technique of trading. A lot of people, a lot of traders I know over the years, including myself, have done very well of trading economic data in this strategy. So this again just shows volatility in the market. So you want to put in your orders around peaks. Okay. So again, this blue line, peak on the upside. Yep. The red line, peaks on the downside. So when the market is moving around, you want to be on the extremes. You don't want orders where the blue and red line are in the middle, because that's the range. You want your orders on the extremes. Yeah, the highs and the lows. That's where your orders should be. So now we can trade the aftermath. So basically this is the way I trade. What you understand what the economic data is going to be released at. If it's non-farm payrolls, it's a figure. So it's expected at 173,000. To be a range on the high side, maybe 200,000. A range on the low side, 150,000. So you trade in between that range. Positive figure within your range, you buy the market if it's stocks. And a negative figure, you sell the stocks. So that's what I do. So again, if you watch any live trading session I do, that will be the method I take. So that means you can try and hit the initial figure, get the initial volatility, and trade the initial spike. You can wait a couple of minutes for the market to take this data on and see if an overall trend is produced. Again, you can trade reversals, Fibonacci reversals, Fibonacci extensions. Again, it's anything you want, but it's again, you're trading the aftermath. You've not made an exact decision. You're waiting for the market to indicate what it could do, and then you go with the volume, the momentum, that strength, and again, with or against the overall trend. Yeah. So again, in an example, we see that the market's moved downwards here. We see the data where this black arrow is released. So the market again moves down on negative data, but it doesn't move that far down. Yes, you have to wait. You have to be patient. So just because you sold the initial figure, again, we see the market test lower but find some support, and it ranges. Yeah, this often happens after a figure because people are making decisions, people are trying to hold positions, and the market's making its mind up. So we sell here, the market ranges, we could have made a little bit of profit, but then look what happens. The market then breaks through the levels of support, goes all the way down, but as quick as it goes down, again, it comes right back up to that level of support, which is now resistance. Okay, then the market takes another dive down to find some support down here, goes all the way back up. Yeah, and then it isn't until we break through that level of support resistance that the market decides, well, actually, we can't actually sustain a higher move upwards. The overall trend continues. We go down, we make lower lows. So the red arrow will be the perfect entry the green arrow, the perfect exit, but we'd have to wait for that entire move for that trade. But what I would suggest is we sell the initial move, yeah, wait for the confirmation of a close below a level of support here, yeah, and take any of that as profit, and the market moves up. We don't break through that level of support, which is now resistance. The market moves down, we can make some more profit, do the same trade again. Okay, we might have to take some pain if the market breaks above this level of support, which we'd then call resistance, but doesn't close above it. Then again, we can sell down, look for our levels of support to be tested and broken through, and that's when we get out. It's not until then that the overall trend continues and we start to retrace that initial move. Okay, so it's all about being patient and giving the market time to filter through this information and trade accordingly. But then again, it's down to you. When you trade economic data, you trade figures. It's down to you to understand the time frames of what you want to trade in. You want to trade the first 5 minutes, 10 minutes, 15 minutes, or the next hour, week, month, whatever. It's all down to the time frames that you want to trade against, and that's where your risk reward should be set against. So in summary, there's 3 simple techniques that we can use to trade any kind of fundamental information. So again, the first one, trading before the event and the news release, offers the greatest reward. But again, it's kind of, you can only call it guessing, unless you're a scientist or you're a market commentator or you're privy to information or not, then it is just a calculated guess. Then again, the second method is less risk, but again, you have to have capital exposed by having your orders in the market. So it does have a risk, but if you're trading on the extremes, that should be better. Then trading the aftermath, that's the least risk because you make an informed decision after you know what the data is. And again, you'll be able to follow me on my live trades, which will give you the added benefit of seeing what I do and asking me questions. Alright guys, well that's how we trade the news. That's an introduction. We have a lot more in-depth sessions that we can tune into around our technicals and individual news events. So do look out for them. If you've got any questions or any thoughts you'd like to ask, anything they do understand, they don't understand. Again, there's no right or wrong questions in this, guys. Again, ask something that someone else in the group might understand or not understand. Okay, got plenty of time, guys. So anything you'd like to ask, please do ask. Okay, Phil? Yeah, absolutely, Phil. Well, all these sessions are recorded, so when you log on to Omnovia, if you go to the recorded sessions, then it's just a different tab on the top. You can then just listen to the recorded session that started when we started, so you'll be able to listen to the first 10 minutes there, Phil. All right, guys. Anything else you want to ask? Anything to do with trading the news? Any thoughts you have on rumors? The use of Twitter? Where do you get your news feeds from? Does any of you guys use the RAN Squawk the Intertrader provide? Do you get your news from anywhere else? Do you have Newswires you subscribe to? Again, guys, got plenty of time. Anything you'd like to ask the group or ask me, or again, just type them through. Again, what I'll do is I'll put my email address down. I know people don't always like talking on the chat window, so again, you can contact me directly. Again, if you want to meet me, I'll be doing live seminars and sessions on the 28th and 29th of September. So you can come and watch me, listen to me in person. Okay, what I recommend is a good news feed. Well, again, Intertrader give you the facility to use RAN Squawk. Now, Rand's a guy I worked with at Schneider's in the city. Very, very good, has a good team around him. So I'd recommend that you listen to your market commentary via RAN. Again, it's a free tool on Intertrader, so it's something you should really look at. Again, for your other news sources, always look at your staples. Look at Bloomberg, look at Reuters, look at any trusted news service. I'd stay away personally from Twitter feeds, but again, if you find somebody who's consistent and that, again, is as a recommended source or you've used in the past, again, it's all the research you need to do and pick out who works in your particular style and who you listen to that again, is good. Anything else, guys? Anything you'd like to ask? Again, it doesn't have to be just about trading news or trading economic data. It could be around anything you like. Got a bit of time. Okay, guys, we have another webinar on Thursday. We'll be talking about some new material. So we're talking about Bollinger Bands and how we trade with them. Again, it's quite an old presentation, hence why the feedback is not as good as it usually is. Again, it's anything you do want me to write about, then please let me know and I'll forward it to the guys at Intertrader. This isn't actually one of my presentations, so hence why the feedback might have been as good as I expected. Again, I'll be doing a whole section on Bollinger Bands, advanced candlesticks. We'll be talking in the future about Elliott's Wave, lots and lots of different things. Again, I'm going to do a whole section on Fibonacci retracement extensions, things that are very powerful in the markets. And again, from the 2nd of October, you can join me on the Building Blocks of Trading course, which has been very successful in its 5th running. So again, lots of information, lots of free education out there, guys. Okay, David's just asking, do you think the euro is going to continue in a bearish direction? Well, again, I don't really give market advice, to be honest, David. But again, I have to look at the overall trend and understand what the euro is trading against. So do you think the euro is going to continue to weaken against the dollar? You know, again, just because the Fed said they're going to keep pumping money into the economy to keep it going, is that sustainable? You know, these are things you have to understand. Is the Eurozone more sustainable in its injection of cash than the US? And if you think so, then yes, the euro will continue down. If you think the US is going to continue to be stronger. Again, you're just playing currencies off the individual constituents sometimes of the Eurozone. Again, remember the US has the benefit of being one single currency and being a united country, whereas although the euro is a united union, again, it's individual countries that we've seen, strong in Finland, Sweden, Denmark, and Germany, weak in Greece, Spain, Portugal. So again, that's the things you have to think about. Phil's just saying you missed the first bit, but would you place close stops when trading the news? Well, yeah, you can do. Again, it's the 3 techniques, David. So if you want to, sorry, Phil, if you want to trade beforehand and wait for, try and predict what the data's going to be, yes, you should use a very, very close stop. Because if you're wrong, you want to be out as quick as you can. If you're right, a stop won't come into play. But yeah, you have to manage your stops around any kind of risk-reward strategy and make sure that it's tight. Always have a stop in place no matter what style you're adopting of trading, because you have to know where your out is. Again, if you don't know where your out is, then you don't know what your overall risk is. So you should always use stops. Well, again, you can use it above support and resistance levels, yes. But you can set your risk management and your levels of stops based around anything. You could do it around number of ticks, overall percentage of your capital, or again, percentage of what you want to risk on each trade, a risk-reward ratio. If you want to make 50 ticks on a trade, you shouldn't be risking more than 20 ticks. Yeah. So you set your stop 20 ticks from your entry point, looking to make 50. If it goes offside against your 20, then that's your risk-reward ratio adhered to. So again, these are things you need to look at and understand. We have whole sections of risk-reward ratios. So again, that's maybe another seminar you should attend, the whole risk management section. All right, guys, anything else you'd like to ask? Any other questions? Again, like I said, it's recorded. There'll be lots more information and lots more seminars coming. Again, we have our live seminars and the course starting on the 2nd of October. So again, lots of support from Intertrader. Yeah, exactly, Phil. That's the risk with news. It can get huge initial spikes. They can get retraced very quickly. So again, it can get you out of positions very, very quickly because the markets will spike. But generally, they don't last for very long. But again, that's the dangers of trading news, but also the advantage. If you get on the right side, you can make good profits. Alright guys, we've got my email address there. Anything else you'd like to ask me, send that through to the email address. I'd like to see you again for the Bollinger Band seminar on Thursday, so please do attend that. If there's nothing else, guys, I hope you have a great evening, and it's been an absolute pleasure tonight. Okay, I'll speak to you all very soon.